Let's take a look at closing the temporary accounts. It's 3 simple journal entries in step 8 of the accounting cycle, but because they're journal entries unlike any other journal entries we've ever done before, they can be a little intimidating when we first meet them. So big picture, step 1, we analyze the business transaction. If there was something for us to record, we recorded it using a journal entry. Debit means left, credit means right. We reorganize the data into individual ledger accounts. We prepared a trial balance. Then we made some adjusting journal entries to get the revenue and expenses into the right periods. In step 6, we prepared an adjusted trial balance. And in step 7, we prepared financial statements. Here's the adjusted trial balance for Freddie's Auto Service as of June 30, 2014. Remember, they're listed in a special order. The accounts are listed assets, liabilities, equity accounts, revenue, and expenses. I've used the convention of writing the income statement accounts in red font and the equity accounts in blue font. Then we took that adjusted trial balance and used that to create our financial statements. We started at the bottom. We said revenue minus expenses gave us our net income. Then we created the statement of retained earnings. We said retained earnings at the beginning of the period plus net income minus dividends gave us retained earnings at the end of the period. Then we listed these accounts up here at the top of the adjusted trial balance, the balance sheet accounts, with their balances. The only tricky part was we used this new retained earnings number on our balance sheet. Remember, revenue and expenses are not on the balance sheet directly, but they get there because revenue minus expenses gave us our net income. Net income would eventually get closed into retained earnings, and then that ending retained earnings balance appears on our balance sheet. But the problem is we have not made any changes to the retained earnings account. We created the statement of retained earnings, if you will, on a separate piece of paper. Closing the temporary accounts simply updates our retained earnings account. To help us visualize what's happening when we close out the temporary accounts, the revenue, the expenses, and the dividend accounts, here are the adjusted trial balances for our accounts. And I haven't put all the debits and credits for the cash, but you can see the balance is $36,800, just like it says in the adjusted trial balance. And what we're going to do is we're finally going to do what we said we were going to do all along. Retained earnings at the beginning, plus net income minus dividends gives us retained earnings at the end. As I say, it's 3 simple journal entries. First, let's close the revenue account into retained earnings. Service revenue has a credit balance of $7,500. To make it 0, we're going to debit it for $7,500 and credit retained earnings. Remember, retained earnings is on the right-hand side of the balance sheet. Its normal balance is a credit. So when we credit it with our revenue, we're increasing retained earnings, which makes sense because revenue increases retained earnings, dividends and expenses decrease retained earnings. A company may close its books every month, every quarter, every year. Let's just look at Freddie's Auto Service closing their books as of June 30th. We debit service revenue for $7,500 and we credit retained earnings for $7,500. Let's post that. And now the balance in the service revenue account is 0. We've emptied out that counting bucket, if you will. And retained earnings has gone up by the amount of our revenue, $7,500. The second simple journal entry in closing out the temporary accounts is to credit all our expense accounts to 0 out those counting buckets, if you will, and then debit retained earnings. So expenses decrease retained earnings. Retained earnings usually has a credit balance. We're going to debit it to decrease retained earnings. So we usually do it in one compound entry. Here's the credits to all the expense accounts, and here's the debit to reduce retained earnings. Let's post those. And you can see that all our expense accounts now have 0 balances. We've emptied out those counting buckets so we can start counting again. And retained earnings has been reduced. And the third and final simple journal entry is to close dividends into retained earnings. Dividends has a debit balance, so we're going to credit it for $3,200 and then reduce retained earnings with a debit of $3,200. When we post that journal entry, we see that dividends has been zeroed out, and in retained earnings, we have retained earnings at the beginning, plus net income, which is our revenue and our expenses, minus dividends, gives us our retained earnings at the end, gives us our balance in retained earnings of $18,500. And if you remember our statement of retained earnings, that's what we told the world the balance would be in retained earnings at the end of June 2014.